Welcome, everyone. We're so glad you can join us for this live 2021 Investor Outlook webinar hosted by JFL Total Wealth Management. While 2020 is finally in the rearview mirror, we still face a lot of unknowns. Since President Biden's inauguration last Wednesday, there's been a flurry of cabinet appointments, executive orders, and resolutions. It's hard to track details and know which change or proposed change may have a direct impact on your financial plan. Today, we'll review some key learnings from 2020 and then focus on 2021's outlook. We don't have a crystal ball, but we do have historical perspective to educate you on key areas we think will be impacted. Without further ado, let's introduce our two panelists. Jeanne Kane has an MBA from Duke University and is a certified financial planner. She has extensive experience with analyzing and managing our private clients' portfolios and with developing comprehensive financial plans. Jerry Lynch is a certified financial planner and has been an independent financial advisor for 23 years, working in the financial industry for more than 30. Welcome, guys.
Thanks, everybody. Appreciate your time. We're going to go through a couple different things today. I'm going to talk a little bit about 2020, really what we saw happen over the past 12 months, and I'm going to turn Jeanne over to 2021. We have some questions that we're going to be dealing with at the end. And the bottom line is if we can't get to your question today, I'll get to you personally and just kind of walk you through this. Our goal is to have these types of programs probably on a quarterly basis. So that we can get out the information that we're seeing and help you make better decisions when it comes to money and your family. So that being said, what I want to kind of do is start with a review of 2020. Now, this is the best thing about 2020 is last year at this time, if I was IBM and I'm sitting on $5 billion that I want to invest in certain areas of the market, the smartest thing for me to do is to sit there and do absolutely nothing. If the Democrats get power, we go in one way. If the Republicans get power, we go another way. If you look at the stimulus bill that was trying to come out at the end of the year, nobody could basically sit down and negotiate on this stuff. At least now there is a consensus of what direction we're going. And I'd rather have a direction that we're going than absolutely nothing happen in Congress. I think the Senate being 50-50, there's some positive things that are out there. Number one, I think that's kind of positive is that there's going to have to be some negotiation. On the Democratic side, what's going to happen is some people will be philosophically opposed to some of the bills that are coming up here. Some will be up for re-election and they're going to be very concerned about their seat. And it means that they're going to have to do a little bit more mainstream things where the Republicans and Democrats hopefully get together and kind of come out. I think there's going to be a surge coming out of this thing. Every retiree I talked to said, I am dying to go on a vacation. I want to go on a cruise. I want to do all these different things. I've been sitting in my house now for the past 9 months and I'm just dying to do something. And I also think that I like Janet Yellen. I am very happy that she was nominated to the Secretary of Treasury. I think she's a brilliant woman. She knows a lot of stuff. She's had very high level positions in finance in the federal government. And I think she's going to kind of create some balance and try to make sure that the rules and the money that they're throwing out to all the different areas right now have a good theme to them and they make sense financially. That's the biggest thing I want to make sure is the numbers make sense. So if we take a look at 2020, there's a couple of things that were definitely very interesting. The S&P went up 65% from the time it dropped in March. And it ended up the year at 16%. I mean, if you had gone back to me in March, I would have locked in a 10% loss just to kind of step back from it. But for everybody that remained consistent, you rode through it, and then we saw a nice rise. Global stocks actually went up pretty good too. They were up about 14%. Again, I would never have anticipated that looking back there. Interest rates remain incredibly low, which is good, and it's also bad depending on how you see it. And it looks like they're not going to be changing for a period of time, but some of the bonds actually did relatively well. I think the biggest thing that everybody got out is the political and social unrest. And I'm very tired of the discourse that we're seeing out there. And, I would like to just kind of focus on things that are more productive as opposed to things that are destructive. And then finally, the economic shutdown. We work with Union Square Hospitality Group in New York City, one of the biggest restaurant chains, Danny Meyer. 95% of their workforce got laid off. I doubt some of those businesses or those restaurants are coming back, because by the time they can open, many of their employees are going to move to other jobs. You can't be unemployed for 9 months. They got to find something else. There's been a lot of people that died from this, and a lot of you have been impacted by this. So I think we got to take a look at this and say, all right, how do we move forward? How do we move ahead? And how can we take some information out of this and work a little better? So with the stimulus programs that are out there, they passed another one late in December. You know, it took them a very long time to get together. Whatever one party wanted, the other person didn't, and vice versa. And more money is going out to small businesses. And the businesses have the ability, if they use this money, if they were down more than 25% last year, they could get this money from the federal government and basically have it for free. They're not going to have to pay it back, provided they're using that money to keep their employees. There's money for vaccine, transportation. There's a lot of money that's going out to certain industries and so forth. The airlines were kept out of it. There was a couple other things I thought they should have included, but that was another $900 billion. You know, the U.S. economy in general is probably, what is that coming out to? About $21 trillion a year. So in this stimulus program, and what they're talking about, you're looking at a 25% boost in terms of money that's going into the economy. That could create some very, very powerful things. So one of the things that we see is, again, in March, we have all this unemployment, all these companies shutting down, everybody's working from home, and all of a sudden, from April on, as I mentioned before, you saw a 65% increase in the stock market over that period of time. And really the question that people have to me is, how could that be? How could the economy be so bad where people are losing their jobs and they have to put out these stimulus programs and the stock market's going in another direction? And I think the simple answer to that is the economy is what's happening right now. The stock market is a prediction of what's happening in the future. And basically what people see is that coming out of this dip, there's going to be a lot of money that's being thrown at it, whether it's through the government and so forth. And here's an idea of some of the stuff that we're seeing out there. So TSA, which is really dealing with, you know, airlines and so forth, versus the previous year, you know, you're down substantially. Again, very few people are getting into airplane at this time unless they have absolutely no other choice. And it's going to take a while for this business to come back. Also, if we take a look at the restaurant industry, I mentioned before, Union Square, which 95% of their population was laid off. It's going to take some time for people to feel comfortable going into a restaurant, first of all, and staying there. And then also for them to get the people back and get their business models changed. It's going to force them to change. And you actually see that with Uber Eats and a lot of the other services that are out there. There's been some surges in businesses that support restaurant groups that bring food to your home so you don't have to go out there. So I think, excuse me for a second. I think most businesses do business the way they are until something comes and it bats them in the head and it says, you know what, you got to rethink that. And when you rethink it and you redo your business model, you actually come out with some ideas that you wouldn't have thought of if things just kind of remain the same. So when we're looking at all of this stuff, and again, the S&P 500, you could see in March where it dipped and where it went up to. There was a tremendous disconnect between what's happening in the economy and what's happening within the stock market. But I'm going to tell you a little secret, and if you could write this down, hopefully everybody has a notepad. Write this down, 444. What I'm good at is I understand numbers, and I understand how this stuff works. And the numbers are 1 out of every 4 months, 1 out of every 4 quarters, and 1 out of every 4 years, you're going to lose money in the stock market. It's kind of how it works. I looked at that over a 100-year period of time. But it also means that 3 out of every 4 months, and 3 out of every 4 quarters, and 3 out of every 4 years, you're going to make money in the stock market. Now, again, short term, I can't predict what's going to happen. But if I could go to Vegas, and I'm not a gambler because I hate losing money, and I knew I could go play blackjack and win 3 out of every 4 hands, what I would do there is I would invest exactly the same amount over and over and over. I wouldn't raise my bet. I wouldn't double down. I wouldn't split hands. I wouldn't do anything. I would let the averages come up. I don't know what's going to happen in the stock market over the next 3 months, 5 months, 12 months, 2 years. But I do feel comfortable saying 5 years from now, 10 years from now, 15 years from now, the stock market is going to be substantially higher. And if you're still working, I think it's a tremendous time to be investing in a volatile market. You could take advantage of these dips. Anybody who invested in this dip in March, if you were investing in your 401k plan in an S&P 500 fund, got a 65% rate of return on money that you put in over those 4 weeks. Now, again, if you're retired, we need different strategies. We got to take a look at that as well, too. Everybody always says to me, what about Tesla? How come we're not in Tesla? Don't get any of those Bitcoins, all right? So one of the nice things about mutual funds and even index funds, and I'm a big fan of indexing, is that you participate in the overall market. You're not picking individual stocks. If you take a look at the FANG stocks, and basically what that is that's Facebook, Amazon, Apple, Microsoft, and Google, and you looked at it over the past basically 8 years, their gains were 4 times what the S&P 500 were. And if you took out those funds, you took out the top 24 performing funds, the S&P last year would have been negative. So what you're doing is you're blending risk and you're pooling it. So you're not going to get the highs of the highs and you're not going to get the lows of the lows. With some of these individual stocks, if you had chose Boeing as an example and had your money, which I think is a very good company, it's going to take some time for them to come back. What I like about the indexing is it is kind of boring. I'll totally admit that. However, over a period of time, I could participate in the market upside, and it's a lot more predictable and stable. This is why you index. All right, so one of the things that people ask me, all right, and this was traditional retirement. I'm going to retire, I'm going to have $1 million. I'm going to buy a 5% CD. It's going to kick off $50,000 a year. I'm going to have my Social Security benefit for myself and my wife. I'm going to get 100 grand a year, never going to touch the principal. Life's grand. That CD just renewed at 0.21%, which means your income went from $50,000 a year to $2,100. It forces you to take change. So the thought that I'm just going to live off the interest really doesn't work. Now, one of the questions people say, well, I just put my money in there for a period of time. The question I always have is that reasonably, if you stay in this investment, A, will you get a positive rate of return after taxes and after inflation? And the reality is with these types of investments, you are guaranteed to lose money on an after-tax, after-inflation basis, guaranteed. I never want to put my money into an investment that I am guaranteed to lose money. Now, if you need money short-term, you want to buy a home, you're investing in a business, whatever the case may be, yeah, put it on the side, but it's not a long-term thing. The question I always ask people is that how long will it take you to double your money in that type of investment? There's a simple rule called the rule of 72. You take an interest rate and you divide it into 72, and it's going to tell you how long it takes to double your money. So if you're putting your money in a bank account money market right now, it'll take you 800 years to double your money. If you're in that high yield CD at 0.21%, it's going to take you 450 years to double your money. And if you're in a balanced stock portfolio, and this is not the top numbers, this is a reasonable number that over a period of time you should make, you should average about 7.2%. With 10 years, your money will double. And this is really important because you need to outpace inflation. And you have to make sure that 30 years from now, if you're retired, that you have enough money to get through. So I'm not worried short term about what's happening in the stock market. I know that the numbers work for me, 444. I know 5 years, 10 years, 15 years from now, the stock market will be higher than it is right now. Short term, I need to make sure I protect my cash flow so that if I need money, I have the ability to get it without having to sell stocks at a discount. And I do think over a period of time, this stuff is going to work fine. Now, again, what the question that everybody is asking me is, as I go into 2021, how do I feel? I feel pretty good. I feel good about the fact that I'm hoping that Congress is going to be a little bit more compromising and that we have a direction that we're going. I think businesses will feel more comfortable investing money if we're going this way. They didn't feel comfortable with that next year. I think if you throw $5 trillion at the United States economy, which is basically like 25% of what we normally do, there's going to be powerful things that happen in the stock market. So for the next year, I could see this thing being good. Now, Jeannie's going to talk about some of the changes and things that we see happening And at the end, what we're going to do is just do a recap and tell you some of the questions that people have already submitted. We'll try to answer those for you. Back
Thanks,
again.
Greg. Thanks.
Thanks.
So I'm sure many of you, if you were like me, you were thrilled to say goodbye 2020 and looking forward to 2021. But with a new year, what brings new challenges and new opportunities. And along with the new year, this year, 2021, we have a new administration. And along with that is going to come some change. President Biden, presented his tax proposal back in the fall. And, of course, it always has to go through Congress. And so there will be some changes from this, and probably may not even look like this, but here are the things that are out there that are key that would potentially impact you. Now, starting out back in 2017, the previous administration passed something called the Tax Cuts Jobs Act. And it did a couple things. It reduced corporate taxes from 35% down to 21%. It also decreased the top marginal tax bracket. And the marginal tax rate, this is the rate that you pay on the next dollar that you earn. So it's the highest one that you pay. And for the highest earners, they dropped that from 39.6 down to 37. And so what Biden is proposing is to kind of increase those and bring those back up. So the corporate tax rate going from 21, not bringing it all the way to 35, but bringing it up to 28%, a little bit more in the middle, and then increase again for those that top tax bracket, moving it from 37 up to 39.6. Now, this 39.6, this is really for taxpayers earning $400,000 or more. He's not proposing any changes to any of the lower brackets. So if you're not earning more than 400,000, you're not going to expect an increase in the individual tax rate. If we look at capital gains rates, those are also an increase he's proposing on the table. And this, again, it's only for the top earners, so people earning $1 million or more, and effectively would be doubling their capital gains rates. Because right now, the way capital gains are taxed, they're taxed at preferred lower rates. So the top rate is 20%, and then 15% or 0% for people with lower income levels with that. So again, this would be looking at increasing it again for just the top earners there. For itemized deductions, proposing a cap of 28%. And what that means is that for each dollar of allowable itemized deductions, that could reduce income tax by no more than 28 cents. So again, this is a target towards the higher and the highest earners out there. We'll also be looking at phasing out the small business, the QBI deductions for those earning more than 400,000. And then something that's really important that he has in the proposal is eliminating the step up in basis. And basis is effectively what you pay for an asset. So for example, if you say your dad bought a house and he paid $300,000 for it, and then he passes away, and then you inherit that house. At the date that he died, say that house is now worth $600,000. That's your basis at that point. So you inherited his basis on the date that he died, and then for you, if you sell it, you paid capital gains on any amount above that $600,000. The same thing holds true for investments as well. What Biden is proposing is saying getting rid of that step up in basis so that if you were to sell that home, you would pay a capital gain from any amount above $300,000. So it's a big difference there. And then finally, the last kind of big item on the tax proposal is reducing the estate tax exemption. Right now, per individual, it's 11.7 million per person, and this would be reducing it down to 3.5 or 7 million per couple. So right now, the vast majority of Americans do not have an issue with the estate tax, but lowering this, more people are potentially going to be impacted. And if you're in this kind of this estate area, you need to start thinking about some different tax planning strategies and with your estate. Now, obviously, again, this is a proposal. And with the very slim majority the Democrats have in Congress, and as Jerry mentioned, not all Democrats think exactly the same, the scope of this will likely change. Now, a couple other things to think about with tax increases potentially on the table, that some of these are going to be easier, the proposal will be easier to pass than others. Easier ones being increasing the corporate tax rate. or bringing back that higher marginal tax bracket for the highest earners. And again, this is not for people who make less than 400,000. These are our top wage earners. Things that might be a little harder to change and to pass through would be, changes in the estate tax. Thinking about the vast majority people don't have issues with it, but as more and more people do have a potential issue with the estate tax, I think it's going to be harder and harder to pass through. And then that capital gains. Pushback here wouldn't just be from people who are saying, well, gosh, I don't want to pay more on my investment earnings, but it's likely going to impact businesses and particularly family-owned businesses as they pass things down from generation to generation. Now, when would we expect to see these tax changes in tax law to go into effect? Most likely, should something pass this year, it doesn't go into effect until 2022. I mean, there's very little precedent for something happening this year and then having it go into effect right away or retroactively going back to the beginning of the year. And then finally, don't expect the Biden tax increase bill to come across, his desk. Most likely what will happen is that there'll be a tax increase coupled with some sort of a spending bill. For example, maybe increasing the corporate tax rate along with putting that and bundling that with an infrastructure spending bill, something like that. Now, some other key issues to look at for investors, be aware of, executive orders. Biden signed 17 executive orders on his first day in office, and a total of, I believe now it's 31 within his first few days that he's been in office now. There are a lot of policy changes that happened, in the last 4 years, and that this administration doesn't agree with. So, particularly as they relate to immigration and the environment, so we'll be seeing some of those reversed or changed in some way. Now, big tech, we're looking at that scrutiny. It's going to continue. Big tech's going to be under the microscope. Anti-competitive behaviors and scrutiny around business practices, particularly after what happened on January 6th, is really going to put them in the hot seat. And then as we look at China, the key question today is, will the policies that were created under, the last administration, the tariffs that Trump put into place, are those going to continue under Biden? And time is going to tell with that. Now, one thing that's, kind of exciting that's coming down the pike, or potentially coming down the pike, is a bill called the Securing a Strong Retirement Act. And this was working its way through Congress back in late 2020. And it had bipartisan support, which that's actually a really nice thing. And this is really going to make some changes and positive changes to the ways that you would save and potentially have to spend in retirement. Well, the first thing that it did is that it increased the age when you have to take required minimum distributions. And this is when you reach a certain age, and at that point, the government says you have to start taking money out of your IRA or your 401k. And people, if you're a retiree, if you don't need the money, you do not want to do this. They get really angry when they have to take their money out. So by increasing it, that's a good thing. But it's also really being put in place because Americans are continuing to live longer, and we need to be able to stretch the retirement savings out to last a lifetime. Also looking at eliminating the required minimum distributions for if you have a total IRA, 401k, kind of your retirement account balances, that's less than 100,000, they'd be eliminated. The proposal would be to eliminate that. And then increasing the amount that you could do for qualified charitable distributions. Now, this is for folks who are of age where you have to take a required minimum distribution. And instead of taking a distribution out from your IRA, paying taxes on it, then writing a check and sending that off to a charity, you can write a check directly from your IRA to that charity. And it's a benefit that more money that you're taking out goes directly to the charity, and they're increasing the amount that can be done each year from 100,000 up to 130. And then the last one that's kind of a provision that we wanted you to be aware of in this potential bill is an increase in an increased catch-up. It's really a second catch-up. So at age 50, you're allowed to start putting in additional $6,000 into your 401k or additional $1,000 into your IRA. And this would add a second time frame. When you turn 60, you'd be allowed to put an additional amount in there as well. So again, this bill that's working its way through Congress, it's not a done deal, but with bipartisan support, we think that's helpful in today's political climate, and we're hopeful that this would potentially come into law. Now, Jerry had mentioned the stimulus plan that happened at the end of 2020. And that was really, if you remember that bubble chart there, the biggest bubble was really around small businesses. And Biden's proposed a very large stimulus package of an additional $1.9 trillion. But this bill seems to be a little bit more focused on individuals and getting people back into the workplace. Now, keep in mind, and this, this is as of Friday, news reports are that, some in Congress are, that people are a little hesitant, and the representatives are a little hesitant about passing another bill so close to the one we passed in December. And I think I actually listened to something yesterday that said that Biden maybe was doing a little signaling that there might be some room for negotiation and compromise in this. But we just wanted to share with you kind of the key provisions that we think would be of interest to you. And the first would be that additional $1,400 support going out to individuals and dependents. The child tax credit, right now, if you have a child age 16 or younger, you get a $2,000 credit on your taxes. We increased that up to $3,000. The pause that was put on student loan repayments would be extended further out, and also an extending unemployment benefits out through September of this year. Another proposal with this would be to increase the minimum wage to $15. Now, many states have already done this or are phasing it in, but this would kind of make it like law of the land for across the entire country. And then finally, kind of looking at heading for additional financial assistance to help open schools and get kids back into a learning environment, which may be more productive for students than trying to learn from home. Now, talking about the financial market sort of outlook in 2021, and again, we don't have a crystal ball, but Jerry talked earlier about, we feel pretty positive about kind of where things might be heading in 2021. 2020, the major indices all closed out on a positive note, and as we enter the year, we feel pretty favorable outlook. Now, Barron's recently surveyed, some market strategists and chief investment officers on their outlook for 2021. And this group's average year-end S&P 500 forecast, they had that increasing by 9% this year to about 4,040. The panel also predicted that the U.S. economy would grow by 5% this year. It would be its fastest rate since 1984. Now, that would be really healthy, considering what happened last year. The gross domestic product, it dropped by 31% in the second quarter, and then it started to rise, and it kind of grew by about 33% in the third quarter. So we're starting to see some recovery, and again, as vaccines come into play and as more things open up, and Jerry talked about once people can travel again, certain sectors of the economy are really going to take off at that point, we believe. So we think there are some positive things. Now, while positivity sounds great, we do anticipate volatility in this coming year. And it's very important as an investor to review your risk tolerance and your time horizon, and to ensure that you feel comfortable with where you are and feeling that you can withstand kind of the ups and downs and the volatility, that comes with the market. Now, the next thing we want to talk about, the biggest question, that we've been asked this question a lot, how does the question, if we have a new administration and we have the Democrats in power in the White House, we've got Democrats in Congress, and we have Kamala who can break a tie in the Senate, what does that mean for the markets? How is this going to impact us? So what this chart does is it looks at the Dow Jones Industrial Average over the past 120 years. And it lists kind of the difference of what happens if we have a president who's a Democrat, Republican Congress, Democrats split Congress, vice versa. It looks at all these different options, and it says, what is the annualized return during that period of time? So if we look at the top line there, we see we've got a president who's a Democrat, a Republican Congress. On an annualized average on a time, it's going up about 9%. Now, I doubt many investors, if you look at my red circle in the middle there, I doubt many investors would have looked at that and said, if I said, we have the Democrats kind of running everything, or the Republicans running everything, that they would have the exact about 7% return. And again, it's the same across the board. And what's interesting about this too, it happened 57% of the time we had one party in power or the other party in power, and this was about 68 years. So over that period of time, both parties, no matter it was Republicans or Democrats, had about the same 7% return in this particular average. I thought that was really interesting. Now let's take a look at it a little bit more depth here. If we look at, even more personal, I would say, because we look at the last 9 presidents in office. And if I look at this, and what I really love about this slide is that, if I'm looking for a pattern to say, well, gosh, if we have a Republican power, Republican in the White House, the markets are only going to go up, or a Democrat, it's only going to go down. There's not really a true pattern as we look at this. And that's really because there isn't one. Because there's so many different factors that go into influencing the market and stock prices. We've got oil prices that do, the economy does, what's going on around the world, what are foreign leaders doing? Like these factors, if not thousands or hundreds, even more, have an influence. And that's not to say that the president doesn't have an influence, but it's just to say that there's so many other things going on in the economy and around the world that have an impact. It's to say that this party's in power and this is exactly, what's going to happen under this president. And it has more to do with kind of what's going on around the world than that person sitting in the seat. Now on this next slide, this is for, I'm going to call this our partisan investors out there. And this looks at the growth of $10,000 over a period of 120 years. And we look and say, if I invested that $10,000, but I only invested it when if just the Democrats were in power, I was invested, or if just the Republicans were in power, I was invested. If not, I pulled my money out of the market. And if I was that partisan investor, over the 120 years, my $10,000 would at most have grown to $430,000. But if I was an investor that kept my money in the market, regardless of the politics, regardless of who was in power, my $10,000 would have grown to $4.2 million. The key here is really to focus on the long term and maintaining a consistent approach, regardless of who's in power, and not react to a changing political climate. Now, looking ahead, way ahead, we're looking at 2022 here. Jerry kind of mentioned a little bit about kind of what's going on in Congress. We've got in Congress we have a slim majority with the Democrats in power. They've got 221 Democrats versus 211 Republicans, and the Senate split evenly. So this really isn't a slam dunk for the Democrats to get their proposals passed without issue. And then also historically, we've seen since the Civil War that the president's party, they really had been had a rough time in those midterm elections. And on average, in the House lost about 33 seats, and in the Senate lost about 3.5 seats. So, and there are retirements, and actually even today, the Republican from Ohio announced that he was going to be retiring. So there are maybe more and more retirements that would have more seats coming into play. The net here is that, based on historical data, there's a chance that the majority may shift at the midterm elections. And with the slim majority, the slim margin the Democrats have today, they're really going to need to work across the aisle to help get legislation passed. Now, here are a few more things and updates that we want to make sure that everyone's aware of. They weren't just reminders as well. So the first thing is that if you have to take a required minimum distribution in 2021, you do need to take it. Last year in 2020, it was a really special year with the CARES Act where those RMDs were waived. This year they're back and you need to take them. And if you're of that age, we will be reaching out to our clients to make sure they're aware of what they need to take and figure out the best time that you want to take it. And then secondly, with the newest kind of PPP loan program, this allows for small business owners to go back and apply for second loans, or if you didn't get one the first time, to go back and apply for your first one. And there are some amended guidelines associated with that, so we want you to make sure you reach out to your banker or your lender to find out kind of if you're eligible and what you need to do as a next step. And one thing that was interesting about this is almost looking at this as like a double dip, and that the loans have the opportunity to be forgiven, and they also could be potentially tax deductible as well. So there's talk of this being a double dip related to these loans. And then finally, the tax deadline this year is the same old tax deadline of April 15th, unless you're filing an extension. There is one new caveat this year, although the IRS said they're not accepting any tax returns until February 15th at the earliest. So Now, I'm going to actually turn this back over to Jerry, and he is going to share kind of some of the answers to your questions of the what keeps you up at night. Here you go, Jerry.
Thanks. So one of the most common statements I hear is, but this is different. Now I've heard, but this is different, and after 9/11, after 2008, after Black Monday, after the 2000 tax crack. I've heard so many reasons why it's different. And the bottom line is things have a tendency to kind of even out over time. So one of the first things people are asking me, what about from a wealth preservation, family wealth preservation standpoint, should I be giving away my money? And when I say I want to give away my money, my natural gut reaction is to tense up and say no, right? I am not a fan of giving away money until I'm absolutely sure I don't need it. I'm not going to give it to my kids because even if I trust my boys, I may not trust my boy's wife. Once I give it away, it's not mine. So unless I'm sure there is absolutely no way I'm ever going to need this amount of money, then I want to preserve it. And then once any rules come out, we could figure out a way around them. We could do things with life insurance trusts. We could do things with family limited partnerships. There's a lot of very sophisticated techniques we can do to reduce the size of the estate while maintaining control. And I think that's important. Another question that people have for me is that how do I protect my portfolio during a market crash? And there's two different ways I'm going to look at this. One is going to focus on retirees. And I've had this conversation a lot in March with everybody who is retired. And the first thing I want to do is I want to take a look at how many years do we have before I ever have to sell a stock at a discount. So I want to take a look at your pensions. I want to take a look at any annuities you have, any Social Security benefits, and see what that income comes up to. Then I want to review your portfolio and see how many years at 0% interest can I take out the cash and use the bonds to basically support your lifestyle without changing anything. When I went through that conversation with people in March of this year, on average, it was 12 to 15 years or more before they ever had to sell it. You give me 12 to 15 years, I'll give you a reasonable rate of return. That's what's nice about how the stock market works. Now, if you're younger and you're still working, I'm always going to say this: have a foundation for your financial plan. If you need money within the next 5 years, never give it to me. Save it in a bank. I don't care if it's going to take you 800 years to basically double it. We're not leaving it there for 800 years. So if you're investing in your own business, if you're buying a home or something like that, keep that money on the side and allow your money to go through some of this market volatility. Again, during that period of time, continue to invest. If I had to go back to 2000, to 2008, to 9/11, and even to March of last year, and I could do one thing differently, I would have dumped as much money as I physically could into the market over that period of time, because over time, the market's going to go up. The other question is, again, market correction. What was that? Analysts believe, again, is there a point when the disconnect to be adjusted? Analysts believe COVID vaccine will have a positive impact, but there's no certainty. All I know is what I see. I see everybody dying to go on vacation. They want to get on an airplane and visit their friends in different parts of the country and their family and stuff like that. There's a lot of people that have money that want to spend it, especially the retirees. And I think between the stimulus that's coming out from the federal government, again, you're talking about $5 trillion of money. 25% of the US economy is being put back in there. Loans are going out to businesses that are forgivable, that basically allows them to keep their employees. And once the vaccine is kicking in on a regular basis, and this is controlled, and I know there's going to be some strains that will be a little bit harder, over a period of time, things are going to get back. The nice thing, though, is that things have changed. People now, businesses are realizing, you know what, I could have my employees work at home. I don't need as much commercial space as I have right now. Businesses for restaurants, you have things like DoorDash and things like that my kids have been doing and delivering food. It's making it more convenient. So a lot of businesses have changed their business models tremendously over the past year, and that would never have happened if the world was just the way it was. One of the questions people have too is increased taxes. Now, I say this to everybody. People have a tendency to take a look at what's happening at this moment in time and project that into the future. It's normal, I understand it, but it's not real. Taxes will continue to change over the rest of your life. There will be market volatility in the stock market for the rest of your life. There will be another 2008 out there at some point, so we need to plan on it. With taxes, what I say to anybody who's retiring is you need to have multiple tax strategies in retirement. Tax-free, which could be return of principal. You have money in a bank account, you take it out, that doesn't create a taxable event. Roth IRAs, take that money out, no taxable event. Income from muni bonds, not a taxable event. Sale of a primary residence, up to $500,000 tax-free. That's one bucket. Capital gains, that's money that's been in the stock market for a year or an investment for a year. If you sell it, the tax rate is 0, 15, 20. And then there's ordinary income, which is money coming out of traditional IRAs, interest on bonds, and so forth. If you believe that that the tax rates will change in the future, and you have those three buckets, if the tax rates on ordinary income increase, I take from my tax-free money, and I take from my capital gain, and I take less money from my ordinary income, which is my IRAs. If tax rates go down, I take more money from my traditional IRA and allow that other money to grow. The bottom line is we need to have a good strategy in multiple situations, because there will be multiple situations. And the tax cuts galore could be permanent. So again, I think right now the impact of what Biden is talking about really is for people with incomes above 400. And if you're a business owner, we could figure out ways to make that income go away. We could do better 401k plans that could get you more money. We could do pension plans that allow you to get more money. There's a lot of different things that we can do. The other question that people have is on cryptocurrencies. And this is my issue with cryptocurrencies. I don't understand them. I mean, I talked to one of my buddies is an attorney that worked with the Winklevoss twins in basically setting up a lot of this different things. And we have a golf trip that we go up to the Cape every year. I sat with him for 4 hours and I didn't understand the benefit of it. And that was my frustration. I don't understand how it goes up in value. I see that countries hate this type of stuff because they can't monitor it. And I can see it being great for drug dealers, for money launderers, or anything that's out there. I see countries having big issues with kind of understanding the benefit, being able to regulate it, being able to protect their citizens. So I'm not sure if it's something that, again, at least at this time, I just don't see the benefit of doing these things. There was another question that people have, and you know, just dealing with guaranteed 5% for retirement. And again, I cannot stress this enough. You know, historically, the stock market goes up 10%. That's if you're 100% stock. There's volatility. You got to build it in. If you're just saying, well, the stock market goes up 10%, I'm just going to take 5. What about a 2008 when the market's down? It doesn't work. When I talk about retirement, the biggest thing I say is that A, we need different tax buckets, but more importantly is we need different investment buckets. Short-term, mid-term, long-term. Short-term, I don't have a clue what's going to happen short-term. I did not see this thing happening this year. I didn't see anything like this happening this year, but it's going to happen, something like this. If I protect my cash flow and I have a good 5 years worth of conservative investments, it allows me to get through some of the volatility that's out there. And it allows my money to grow at a reasonable rate of return. If interest rates are at 0, putting your money in a CD and getting 0.21% is just not going to cut it. So you need to make sure that you have a reasonable rate of growth. So it means that you need to have some money at risk in the stock market. But I do believe in the odds. And over a period of time, I believe the stock market's going to go up. It should go up at a reasonable rate of return. And it's just a matter of you need the time to do it. Short term, protect your cash flow. Was there anything else that I had to hit here? Oh, yeah. Last thing with taxes that I just wanted to mention too is Janet Yellen. I think she's a brilliant woman. I think she's going to give a lot of positive influence to Joe Biden in terms of how do we structure taxes? When do we put these taxes in? I heard her talk about tax parity with other countries and negotiating different tax rates, because right now countries are having a race to the bottom on corporate tax. You know, Ireland is substantially lower. The reason why Trump reduced it from 35 to 21% is that most companies were setting up subsidiaries overseas so they could have their income reported over there. I think our taxes need to be in line, and I think Janet's approach towards this is pretty positive. So I don't know if there's any other questions that we needed to kind of talk about. Gretchen, was there anything that came in that we should hit on?
No, I think that's it, actually. There was one person who did ask a quick question, was just to clarify whether the $400,000 income level for the taxes to potentially be increased, if that was for an individual or a joint filing couple. And we did want to clarify.
Yeah, that's a joint filing couple. But the biggest thing I would say is don't worry about this stuff until we get an idea of it. I'm already kind of thinking about this thing and working on plan B, plan C, plan D. I don't want anybody to commit to strategies that may not work if certain things don't happen. So I think that at least for this year, it's going to take some time to implement it. There's a lot that they have on their plate right now. So we probably have a year of planning. We should be able to see how everything is kind of fading out in terms of what's happening in the Senate, what's happening in the House, how are people doing things. And then based on that, we could come up with some ideas. Again, on the tax situation, I think everybody knows I have a tax coach, Bob Keebler. He's not an elf. Everybody always asks that, is he the elf guy? No, he's not. He's probably one of the top 10 CPAs in the United States. I meet with him on a regular basis. We look at this stuff. We develop complicated strategies for people that need relief on their taxes. And again, the more they come out with more complicated rules, the more we got to work and figure out how to work around them. So again, I'm not worried about this. I think it's going to be fine. You know, I think that right now, I'm just happy that there's a direction that we're going in. So.
All right. Well, thanks, Jerry. And yeah, thanks to both Jeanne and Jerry for this presentation. And I think we can all agree that there's a lot of moving pieces that are going on, that are happening right now, and they're changing daily sometimes. And we hope that this provided a little clarity on some strategies that you might be able to follow. And as always, please call the office. We're more than happy to talk about your personal financial situation. So until next time, stay safe, especially everybody who might be around in the snowstorm right now.
Thank you.
Thanks, everybody.